Well, welcome everyone to our webinar today, which is about improving property renewal outcomes. And this is part of our Building Business Resilience series, which is really about improving your total cost of risk. And so we know insurance spend is a significant component of what you spend on risk. And so today, given property insurance premiums are increasing and can be a significant component of your total cost of risk, this is our first of many sessions. Just a few things to get started is there is a Q&A function today, which is on the webinar. So when you've got questions, please put them into the Q&A function, and we'll at the end have some time for the Q&A. There's also a very brief 3 or 4 question survey that will appear when the webinar finishes, and that will just help us get some feedback from how you enjoyed the webinar and some other sort of content you'd be interested in learning about, and if you'd like us to make contact with you about anything that we're talking about today. So just to get started, who we have today is we've got Rob Gardner, who is our Head of Property Risk Solutions, and Rob is responsible for across the Australia area for property risk engineering, property loss control, and our natural catastrophe loss modelling capabilities at Marsh and that team. I'm the Head of Strategy for Marsh Advisory. Marsh Advisory is the data and analytics and consulting, risk consulting practice at Marsh. And so my role is across the Pacific region. How can we help bring the best of these capabilities to our clients' major risk and insurance issues? And so we'll both be attacking it from different angles today. Rob specifically on the property, and I'll be adding some thoughts as well. So to get started, we're going to be talking about the property insurance market just briefly, because we're pretty confident the broker's done a good job with helping you understand what's happening there. But then we're going to be talking about maximising your property insurance renewal outcomes and finish off with a Q&A. That's the agenda for today. So market update. What is going on with the property insurance renewal market in Australia and New Zealand? Well, there's been over 15 quarters of increases, and an increase of over 30% just in Q4 2020, which was similar to the quarters before that. And that's really driving an increase in rate, but also retention. We're seeing more of a push to increase retentions. There's greater scrutiny on coverage, and we're seeing reduced capacity, and particularly where there's portfolio exposure or natural catastrophe exposures. And so this is really coming off, if you look at prior to 2017, there was what we'd call a soft market conditions. So where it was a long period of flat or decreasing premiums, and that premium pool and that has been significantly eroded by heavy catastrophe losses and attritional losses. So we're seeing loss ratios for many insurers exceeding 100%, which means their losses are far exceeding the premium pool. And so the natural result of that is premium increases, and we're seeing that continue to realize, and that there's a direct impact from COVID-19 that's yet to materialize with that. So that may continue to put pressure on premiums in the future too. So that's all well and good, and we know that, and your brokers probably prepared you for what's happening with your renewal, and that it's likely that there'll be a challenging renewal. So really our job is to talk about what can you do about it to maximize your renewal, to limit that premium increase. And so that's really the main part of today. And we're going to talk about 6 different areas that are worth considering for improving your property renewal outcome. And we're going to go through each of these one by one. Why is it important? And if you need some help on these, how Marsh can help. But I'll hand the time over to Rob to start, who will talk to us over the first couple of points.
Thanks, Zane. If we could just move on to the next slide. So the first practical way we'll talk about practical solutions today is about getting your declared values correct. And that's about getting them accurate and appropriately declared. And that's a priority first in that renewal process. So as we've talked about in previous webinars, there's a continuing focus from insurers on the declared values. They want a recent asset valuation. They want to know how that valuation was built from the bottom up. So what are the constituent parts of that, from both the building structure, the plant and equipment, and so on. They want to know the background and experience of the value involved. And from a BI declared values perspective, they also want to understand how that BI declared value is built up. And that's even more important over the last 12 months, where many organizations have seen a significant variation in their revenues and profits, and ultimately those BI declared values may have materially changed. So what are we seeing successful organizations do to address these issues around declared values? Well, ultimately, they are reviewing those declared values to make sure they're accurate and current, both from an asset perspective, but also from a business interruption. Firstly, to avoid overstating the values. As Zane talked about, in a market where prices are rising, overstating those values potentially is incurring unnecessary premium that could be allocated elsewhere within the business or reallocated to other insurance programs. But the other risk, the converse risk, is understating those values. And that becomes material when, if we have a claim, we run the risk of a part settlement. So it's important we get those right, to mitigate the risk from either overstating or understating the risk. The impact of that is potential, insurers looking to include a co-insurance clause. And we've seen that over the last few years. Insurers are more and more seeking to put that in place where they haven't got a current valuation. So again, a co-insurance clause will potentially impact a claim settlement in the event that the declared values are not appropriately declared. So again, it reinforces the issue of the recommendation about reviewing those declared values and making sure they are accurate and current. Also, a third part about ensuring declared values are current is about protecting the ownership of those physical assets. So, as I just touched on, making sure the declared values are broken down into their constituent parts, so they actually reflect the ownership interest of those assets. So it's not just the physical building structure, but also the plant and equipment that sits within that. That's not only from a financial investor's perspective of understanding, making sure that their interests are protected, but ultimately will lead to a less contentious claim where there is a dispute about those values. So, it's about protecting the interests of the stakeholders and financial interest. And then it's about making sure the declared values are actually appropriately declared in terms of, the program design and how the policy is written. And we've seen plenty of examples where the declared values don't actually reflect the policy terms. And a good example is where we've seen, BI declared values including a significant proportion of variable cost that didn't need to be declared, and ultimately the client was paying premium on that. Similarly, we've seen clients where they've underdeclared BI values because there's been a change in contractual conditions that have now required the client to actually insure that cost, and that hasn't been declared in the BI declared values. So it's about making sure that we can work with you to understand your program design and ultimately make sure the declared values are fit for purpose. And the last point about this is about making sure the declared values, so they speed up a claims process. So we ensure that we have resources that aren't directed away from your recovery efforts, and they can actually have the information available to address any adjusters' questions. So having accurate and fit for purpose declared values is a critical component of that insurance renewal process. So we've got a team of over 20 valuers here in Australia who can provide you with the expertise to build up a declared value schedule. Our forensic accountants based here in Australia can work with you to make sure your declared values for your BI is appropriate and fit for purpose. And we can work with you to make sure that the policy and the declared values align themselves going forward. Thanks, Sam. The second component is about...
Sorry, well, Rob, I was just saying, once you've got your declared values accurate, that really is a good starting point to then look at your limits, and because insurers not only use your declared values when they're assessing the risk profile and pricing, but they look at the limit that you're buying for the total limit and also for the perils. And so, Rob?
Absolutely. So, as we see in the current market conditions, the policy limit and ultimately sub-limits is a major driver in pricing and capacity. In a soft market, we've seen many clients topping up limits and buying limits that have been readily available and relatively cost efficient. But in this current market, we are seeing far more scrutiny and technical underwriting from insurers as they review their book of business, and that's bringing increased focus on those clients with high limits. It's looking at the sub-limits that sit within a policy, be it from damage that's been sustained from flood or hail or so on. And it's ultimately leading to difficult negotiations if our clients don't have a complete understanding of their risk profile. So insurers are using their own loss experience, their own models, their own data, and including assumptions to drive those negotiations on price, coverage, and ultimately those limits. So, what are we seeing successful organizations do? Well, we're seeing them put in place investment about adequate preparation around the data and analytics that will support those negotiations. So, what do I mean around that? Well, the first piece is they're doing maximum foreseeable loss studies. So they're actually looking at what are the worst case loss scenarios that might exist within their portfolio from a property damage and business interruption perspective. And I'll give a practical example where if a client might provide an insured values in a register that lists all of the asset located at one location, that actual location may be broken down into multiple different buildings, and that value is distributed across the site, where the worst case scenario actually might be only the loss of one building. But the way the assets are declared on the schedule, it looks as one value, one location, and ultimately an insurer may make an assumption about the worst case loss. So maximum foreseeable loss study can help you present your worst case loss scenario to the insurance market from a property damage and business interruption perspective. The second key area is around natural perils, and we've seen over the last decade some very large significant claims around natural perils. And so it's about being able to articulate your risk profile to insurers around what's your exposure to natural perils, be it flood, hail, cyclone, bushfire, earthquake. It's important for you to understand what those losses might potentially look like, so which locations are exposed to those perils, and then ultimately have an understanding of what those losses might look like. So why is that important? It's ultimately about you having the best and most informed analysis that you can go to the market and negotiate your position. It's your analysis based on your data, and it doesn't include assumptions. That analysis is done well in advance of renewal, ultimately to allow you to digest the analysis and the information, but ultimately to develop a negotiating position. So what cover might you be able to trade in a difficult renewal? But ultimately, if you are going to take more risk, it allows you to have sufficient time to analyze that data, to work with the management team and the board, and ultimately come to a decision. But the last bit is about how you differentiate that risk using that analysis. So, being able to go to existing insurers and articulate your risk, but hopefully being able to go to new insurers who historically haven't been able to underwrite your risk because of the lack of information, and using that modeling and analysis to actually, get them on the program and create some competitive tension moving forward. So how can we work with yourselves? We have a team of engineers and forensic accountants who can work with you and your sites to build up those maximum foreseeable loss studies. And it's not a case of going to every site, but it's about picking on the worst case sites, those ones which have a material impact on revenue and ultimately large potential property damage claims. It's also about looking at modeling and modeling those all those assets across the asset portfolio, and challenging those limits and sub-limits and making sure they're fit for purpose. And as I said, it's about getting that information so that you can develop a negotiating position. And then ultimately, using NatCat modeling, we can apply your policy program structure to that to look about, what's the balance between risk retention and risk transfer. And many of our clients are looking at options as they go to the market. So the ability to put different policy structures over that CAT modeling is then providing that insight to go to the table with options at renewal. And the last piece is about identifying which sites within your asset portfolio are actually driving those losses, so that we can start to look at, okay, is there the potential to actually invest risk mitigation at those sites and ultimately improve the risk profile? Thanks, Zane. If you want to go on to the next page, a couple of examples. The example on the left-hand side is a piece of CAT modeling we did for a large asset portfolio where it was a desktop study based on the client's data, and a valuation study linking in with that to make sure we had the most up-to-date valuations for the program. The top line is the actual loss curve that was done as a baseline desktop study that showed basically with one dot on one location at the client's site, it generated a significant loss curve. But actually, with our involvement, we were able to identify multiple other data points on the client's site, reallocate the values based on the valuation study that was done, and ultimately drive the loss values down for that client. So we actually go to the market and to differentiate the client's risk and firstly give them comfort that one, they could seek an alternative limit lower, which then brought competitive tensions into the program. But secondly, was allowed to differentiate their risk and attract new capacity onto the program. The other example, and a really relevant one over the last few weeks, is around flood loss modeling. Similar study, a desktop study using data provided by the client. The desktop study identified 20 sites that were the loss drivers in the program. Our engineers visited those sites, were able to distribute the values based on the actual risk engineering of the sites, reallocate the values, and ultimately remodel the program and generate losses that were nearly 50% lower than the original desktop modeling. And what was the benefit to the client? The client owned that analysis. They went to the market and were able to own the argument and the information, and were really able to drive that discussion with insurers. So they had the ammunition, they had the analysis, the insight to basically own that negotiation position. And both were very positive outcomes for our clients. Thanks, Sam.
Thanks, Rob. And so look, we've talked about getting the declared values right, making sure you're not over or underinsured. Similar discussion on your limits, looking at that from an MFL perspective or a NatCat perspective if you've got natural catastrophe risk. The next point is, okay, risk retention. Are you retaining the right amount of risk? And really that what that is about is that insurers, they make a profit margin, they've got administration costs, cost of capital for you to transfer risk to them. So there is a premium associated with that. And so if you can afford to retain more risk and if it makes sense, then you technically will be able to save on premium, not just now, but into the long term if that's a continual strategy. So you want to know, what is your risk tolerance? You know, how much unplanned losses could your balance sheet afford to take in any given period of time? And then you can use that to understand your deductibles and limits. And then you want to look at, well, I can afford to retain more risk, but will it be an adequate reward? Will the premium saving justify the additional risk? And you really want to know those trade-offs when you're making those decisions, so that you can, what we call, balance your total cost of risk, which is your premium plus those losses that you will incur. And so a couple of ways how we help clients with that is we do that risk tolerance analysis, that financial analysis, so you can see what's that room to move on your balance sheet to retain more risk. And the second part we do, it's a more sophisticated look, is where we'll take that modeling, often what Rob Teams does with that CAT modeling, model out those losses. So what does your risk profile, your underlying risk profile for your assets look like? And we can then overlay different insurance program structures and forecasted premium and look at, okay, we know your risk tolerance, the cost, your cost of capital, the premium, the forecasted losses. Let's identify and mathematically determine what is that right structure for you, so that you can confidently go, yes, we're going to increase our retention from 50,000 to 350,000. We can comfortably afford that. We're going to save X amount on premium. We know that the average losses that will incur across the 10 or 20 year period will be enough to justify, won't exceed the premium saving. It's worth us going ahead. And we also take that and get the technical pricing, so we can go to the market and say, look, we use your same pricing models, very similar pricing models, and we know what this risk should be priced at. And therefore, we want to give you that, the transparency, give you that data and help aid with that. So it gives you more control of the program, and also use it to identify layers, insurers who are at different parts of your insurance program, if they're pricing it effectively or not. And if they're not, then that might be a good candidate to retain risk, not just through an increased deductible. You might want to retain it by self-insuring a layer in your insurance tower. And so we look at what's the cost benefit of that as well. And this is an example with a client where we, through this exercise, we looked at, okay, their current deductible structure and their current premium, and looking at what's their average losses going to be per annum at a deductible of 20 million. And we know what their premium is per layer. And we modeled out and identified a new program structure that increased the amount of risk that they were retaining, a different deductible structure, and reduced their premium down. And so by retaining more losses, we modeled out what those retained losses would look like on an average annualized basis, compared that with the premium saving, and the net result was a $380,000 saving per year. Now they'll save more than that because the premium's $530,000 a year that they'll save, but we're also modeling in, okay, well, you should be factoring into that equation that increased average losses as well because of that new retention. And this is what we're trying to, that risk finance optimization, the data to empower you to make better informed decisions around your insurance program design. When you know that, that might lead to you retaining more risk. And so you want to think about, okay, if I'm going to retain more risk, should I be looking at a captive or a discretionary trust? And a captive, as you might know, is a formalized self-insurance vehicle that allows you to retain risk, access reinsurance markets, and build up that risk retention fund over time. And discretionary trusts are similar, but they're based onshore and can deliver very similar outcomes. And so you want to look at, okay, well, if it makes sense to retain risk and it's going to be over a long period of time, should we formalize that structure? And that might give some benefits over trying to retain the risk on your balance sheet alone. And we know when you retain it on your own balance sheet, that can be difficult for building up those funds over time because of budget and other pressures. Often those funds get taken. You may need to provide certificates of currency throughout your business operations. You can't do that often if you're just retaining risk on your balance sheet. So this gives you a formal way to retain that risk. And so discretionary trusts and captives may be that better solution, not just financially, but strategically. And so what we do is we model out that, conduct that risk finance optimization, help you understand those trade-offs between retaining risk and transferring risk, and then look at the feasibility of what's the best way to retain that risk. Looking at the feasibility of a captive or a trust versus traditional insurance. And then if it works, and it makes sense, then helping you establish that captive or trust if the numbers and the strategy seems to make sense. But ultimately, what we're wanting to do is we've got to this point now and we've helped you redesign the program structure. You've looked at the values, the limits, you found the right risk to retain and to transfer the insurance market. Now we need to look at how do we actually reduce the uncertainty with underwriters so that they can provide better terms for their risk. And this is points 5 and 6, and I'll pass it on to Rob to take this one.
Thanks, Zane. Ultimately, as Zane alluded to, it all starts with data. And I think, if data doesn't exist, then insurers are going to feel that uncertainty with the data with potential additional premium, or ultimately reduce their capacity. So as Zane highlighted, it's all about reducing that uncertainty by providing quality data and information to insurers. And whilst we've talked about making sure that our declared values are accurate and that we've had those discussions and determinations around what limits, ultimately it's about providing the insurers with some quality data around the physical assets that our clients have. So I just want to go through and touch on some aspects of what does quality property data really look like. So the first thing we always start at is about having an accurate location, and we see time and time again asset schedules where the data or the way the address is articulated is not adequate for an insurer to identify that location. And that might be because there are aspects of the address that are missing, or just the postcode in some cases provided. But ultimately, it's in a form or format that doesn't allow the insurers to identify where that location is. So a simple, latitude and longitude address, is ultimately just is the minimum piece of information that we need to see in that asset schedule, and that allows the insurer to really articulate and identify where that location of the asset is, to the roof of that building. And we'll go through in a minute some examples of where we see gaps missing and what that ultimately manifests itself. The second piece is around year of build. There are huge gaps we see in the year of build, and why is that important? Because building codes and building engineering standards change, and the models that insurers use reflect the risk that goes with those different changes in building codes. So it's critical to understand the year of build. Where the year of build is missing, then the insurer will assume that the age of the property reflects the lowest engineering standards. So again, it's important to articulate what that year of build is. The construction of the asset, that's an obvious one, but in terms of what's the physical structure, how's it been engineered, and probably more importantly, we see more recently is around the building materials used. So relative to combustibility, whether it's combustible or it's not combustible. Specific examples around that does it contain insulated panel, or ACP is probably the most recent example of that. We've seen some huge catastrophic fires, but many of our clients have moved on from the historic EPS type materials and are now using some of the FM approved products. But again, where the information doesn't exist around those products and they're declared in an asset schedule, insurers will make an assumption around, well, it's potentially EPS, when in fact it might be some better product like X-Flam. So again, it's important about making sure that the information that's provided really is reflective of the risk profile. The fourth key component is around the occupancy. So insurers are interested in, okay, what's the plant and equipment within the asset? Does it come from a reputable manufacturer? Is it being maintained to the OEM specifications? Ultimately, what's the resilience within your manufacturing process? So what redundancy do you have in the event of an outage? The other second component about occupancy is around storage. So what is actually being stored in the location? So is it high hazard? If it is high hazard, what are the controls in place to mitigate the risk? So that's a really key component. And I say where the information is missing, insurers will make that assumption that it's a worst case scenario. Then it's around protection, and ultimately we're talking about fire protection and fire detection, and a lot of that's driven by building code, but ultimately insurers, building code is driven by life safety, and insurers are looking to protect the assets. So there is sometimes an area of conflict around what is best practice and what is a legislative requirement. So we can work with our clients to help them, give them insight as to what's best practice and what potentially might need to be invested in terms of that fire protection. But what insurers looking at the current status is ultimately evidence that there is a maintenance program in place and that there is the appropriate flow testing going on. And we still see gaps where that information doesn't exist. And again, it doesn't really give credit to the investment that our clients have made, potentially where they have a sprinkler system in place, but there is no evidence of testing, then potentially it might be considered an unsprinkled risk. So it's just about making sure that we've got evidence of that. And then it's around exposures, and we've touched on that in terms of exposures to natural perils. And that's a critical, we've seen some of the largest claims over the last few years have been driven by natural perils. So it's about, providing insurers with a really detailed understanding of what your exposure is to those natural perils. And ultimately, what are you doing to mitigate the risks associated with those natural perils? And then the last component about quality property information is around what we call opportunities for improvement or risk recommendations. In a soft market, risk recommendations have been made, but there hasn't been much focus on tracking the progression of those. Well, that's fundamentally changed in a hard market. Insurers are not only seeking to see detailed responses, but are looking to see year-on-year progressive improvement and addressing of those recommendations. Now, many recommendations could be related to management systems, and which are relatively easy to fix, but other recommendations may require some element of OPEX or CAPEX, and also that will feed into a business planning process. So some of the recommendations can't be addressed very quickly, and therefore it's important that where OFIs or recommendations are made, they are fed into the business planning of the organisation so they can be considered and addressed. And if not actioned, then we provide a suitable response back to insurers with a potentially alternative means of mitigating that risk. So, why is it important that all those aspects are addressed? Ultimately, to make sure that insurers have the most accurate picture of your risk, and therefore they can price it accordingly. That they take out any assumptions around your risk and they give you credit for the investment that you've made in your assets. One we see very frequently is that the data is provided to insurers in a format that they can interpret. It's easy for them to analyze and break down. Sometimes we see there's good quality data, but it's not really in a format that insurers can use. And ultimately what we're trying to do is make it easy for insurers to analyze your risk and therefore for you to get the best out of the market conditions at the time. And the last piece around why, it's about differentiating your risk, to make sure that, as I say, the investment that you've made in managing risk is really reflected in the price and the coverage you get from the insurance market. So, how can we help you in a hard insurance market? Well, ultimately, it's about you owning your own property risk management program. We recognize insurers are typically looking to visit many of your sites, but in a market where you need options and you're looking to potentially attract as many insurers to your program as possible, it's about you owning your own property risk management program. And what does that look like? It's about you having your own surveys that you might spread over a period of 1 to 3 years, and that you drive the property risk management standards in liaison with insurers. So we absolutely take on board all their recommendations and their considerations, but ultimately you own the program and it allows you to develop options going into the insurance market. That you have a comprehensive register of your assets and picking up on all those points I just touched on, but ultimately allowing you to start the discussions as early as possible in the insurance market. And then thirdly, it's about you having the standards. You're establishing the standards for property risk management across your portfolio. And we see many insurers recognizing the improvements that have been made, but they're very keen on seeing that the standards are rolled out across the portfolio, and we can very much help organizations with that. And then it's about property loss control. And we recognize that on top of existing workloads, it can be a very onerous process to manage that process. So we can provide support to our clients in tracking those recommendations and giving guidance to sites on how to manage those.
I think a point as well, Rob, is the challenge with just relying on insurers' property surveys alone is that, one, it doesn't give you the flexibility to use that information and market it to other insurers. So like you're saying before, is it gets you into a bit of a, you kind of paint yourself into a bit of a corner there. And so if you're with your incumbent insurer for a while and then they reduce capacity or the pricing is becoming significant, you don't have that survey work to go out and market it to a number of insurers. And so you want to go and take control of that and not be in the mercy only of the insurer's survey work, and be able to drive some of the discussion as well, because an insurer may go and do that analysis, but won't have that connection between, we really work on, okay, how can we drive a better outcome for this? Can we help improve this property risk before the survey goes, and create a roadmap of improvement and working with you over time, so that you're not having an insurer come out, do a survey and it going straight to the insurer and not having a chance to kind of input into some of that conversation and that discussion point.
Absolutely. Thanks, Ian. And here's a couple of just practical examples when you talk about the quality of data. On that image at the top, it gives you an example of where an address data is really missing information. In this example, the client's location was actually in an exposed region, but on the basis of the address, how it was presented, it could have been in the middle of a suburb, or it could have been on a street, both which sat outside of the hazard zone itself. So that's a potential disclosure issue, but ultimately it also doesn't help yourself when you're trying to understand whether your sites are exposed to perils to help you drive risk management. And this is what we see, especially in large parts of Australia where we have postcodes which can be over a significant geographic area. where the risk profile for that postcode can be very misleading relative to your own site-specific exposure. So it might, potentially highlight that you're in a flood zone when in fact you're not. So that's the risk of having misleading or incorrect address data. And as I said, recent examples where we've seen through our own models where ultimately 50% of the asset schedule couldn't be located to a rooftop level, and that ultimately therefore creates uncertainty with an insurer and potentially results in higher premiums. And one of the other areas we see around loss modeling is actually, when I say about our clients owning the analysis, is one of the fall downs we see is where that analysis has been used by insurers to run through their own models. Is sometimes those models haven't been the most current as opposed to the models we've got. So you sometimes can get that disconnect. So having your own program done through ourselves, then we have the most up-to-date models to actually reflect the most up-to-date modeling. And that's a really pertinent example here in Australia over the last 12 months where some of those peril models have been updated to the benefit of our clients. So we have the latest models to make sure the risk is correctly articulated.
I think the key point from this, Rob, is in the absence of this sort of information, if an insurer's got a uncertainty around it, and the difference could be, and this is a really not a exaggerated situation, but it could be the difference between, say, a $50 million loss and a $70 or an $80 million loss because of flood or fire or another event. And that has a fairly tangible impact on the premium, and so if they're going, okay, well, it's a difference. We could be up to a $50 million loss. We could be up for a $70 million loss. An underwriter would generally, in most cases, take a more conservative approach. And so if we can reduce that uncertainty and give them the data that helps them see, actually, it's a $55 million loss you're exposed to here for these reasons, then that will limit them from taking that $70 million loss approach and pricing that in and reducing that uncertainty. So
absolutely, and those images at the bottom articulate, from a historic review of a client's exposure where it looked at a zip code, looking down to a 100-meter segment, we completely change the risk profile of the client and ultimately differentiate their risk to the insurance market. And the last piece is around improving, giving insurers comfort around resilience. And we've spent a lot of time talking about data and property data. But historically, the BI claim can make up 60% of a property damage BI claim. So the BI aspect, the business interruption, is a really critical part in terms of exposure and ultimately managing that risk. So how can we help our clients in terms of managing that risk? So if we just want to move to the next slide, as we talked about in terms of ensuring that the BI declared values are fit for purpose and appropriate to the policy. Ultimately, it's about developing excellent business resilience within the organization, not only because it's good corporate governance, but it can support the determination of the BI program. So what BI limit indemnity periods should we actually purchase? Where we have a tried and tested business continuity plan with excellent business resilience within the organization, and that can drive us to potentially buy lower limits and ultimately lead to saving us money. Conversely, where there isn't sufficient redundancy and resilience to the business, then that will potentially drive us to develop and expand our program moving forward. So, what are our clients doing? It's about making sure that we fully understand our exposures from an organization. So how does that happen? That's about doing a business impact analysis to understand what are the key functions that the business requires to generate revenue or provide a service. It's about quantifying that exposure in terms of declared value that we talked about earlier. It's about putting in place a business continuity plan that can give the management and the board comfort that we've got a plan to strategically manage our way out of a disruption that, again, supports the design of the insurance program, but ultimately gives comfort to our key stakeholders such as financiers, suppliers, customers, that we can manage our way out of this disruption and can prosper from it. And ultimately, like I said, it's about making sure that the business interruption coverage is fit for purpose. And we've seen many examples where that doesn't reflect. And a really good example is where historically a client may have purchased gross profit or protection for revenue, but in fact, because of the engineering that's been built into the organization, the business resilience, they've actually only required additional increased cost of working cover. So the client has been able to evolve that BI program and buy a far more cost-effective program moving forward, which ultimately created capacity and created competitive tension, led to improved pricing. So, business continuity planning, everybody talks about it, but it's a really fundamental component of having a better practice property risk management program. And we work with our clients to develop those business continuity plans. It's not about putting it on the shelf and then hopefully never having to dust it off, but ultimately running exercises to test those BCPs. And what we've seen really successfully over the last couple of years is actually involving your insurers in those exercises for them to see firsthand, how you manage your way out of a disruption and get an understanding of the sophistication around those contingency planning, but also that can then feed back into the design of the insurance program. It's also fundamental about learning from events that have happened in the past, and many of our clients are working through those during this period of COVID to understand the disruption, but also from less significant events to learn. There is always some aspect of a disruption that can be taken forward. It's about learning from that and building that into the business continuity plans. And ultimately, we see crisis management planning as a fundamental component of best practice business continuity management. We see disruptions to operations, but we see that can have a significant disruption on brand and reputation. And if we fail to identify those issues, then that can ultimately have a more detrimental impact on the business's viability. So it's having an integrated crisis management and business continuity plan to move forward strategically.
I think a point here on this, Rob, is that firstly, business interruption losses can often be more significant than the material damage loss. And so insurers are often, what they're paying out is greater for the BI component. So one, you want to make sure that what you're declaring in terms of your declared values, but also what you're insured for BI is accurate, so that you're not over-insuring or under-insuring, because that could have an impact on premium or your risk. The second thing is, like, having that business continuity plan demonstrates that you are going to respond effectively and quickly to that event. But thirdly, there's an opportunity to look at your business continuity planning and how that can interweave with what you're buying with business interruption. Perhaps you can reduce the amount of business interruption coverage you're buying because of an improvement in the way that your business continuity is managed, and so it's always not looking at them in isolation, but working at them together as well is definitely a positive. And so what we've done is we've looked at 6 areas of how you can improve your property renewal outcome. But naturally, the question is, where do you start? What do you focus on first? And we don't suggest that you need to do all these 6 things for the renewal. But what you do is you work with your broker at Marsh and identify the priority areas. It might be that you've been buying a significant limit for a long time, and it may be time to have a look at that because the aggregate risk may be a lot less than the 500 million you're buying. It might be 300. And so that could have a significant improvement to capacity or pricing, so that could be an area that you might want to focus on. Or you might look at, we really haven't been differentiating our risk. We've just been sending the same information each year. The underwriter's getting it. So they're not going to differentiate you from a pricing perspective because you're the same as what they're seeing elsewhere. So you might look at, okay, property risk information is the focus for this renewal. Or you haven't been retaining much risk. You've got really low sort of deductible structures and you've got capacity to do that, then you might look at risk retention. And so that's sort of using a bit of an art and a science to where do you focus now, and that's where the broker can help. We help brokers. We work with the broking team and yourselves to where we think there's that low-hanging fruit for your program. And then you create a strategy. How can you leverage the work that you're doing to maximize it? And it's not about, okay, if you do these things, you are going to reduce your insurance premium, because a lot of this increases in the property insurance market. A lot of that is outside of your control. It's a market pressure. But what this can do is reduce that increase, or at least help you obtain more capacity that you wouldn't have got otherwise. And so, but either way, that is a tangible benefit to the organization. And I think if you want to have when you're going through your renewal and have these 6 areas as a bit of a checklist of how well prepared you are, and that you've considered all these options. We're going to move into the Q&A, but Rob, anything else you would finish off on?
No, I think, we talked about data. Data is fundamental to all of this, be it, if you're considering risk retentions or alternative risk solution strategies, at the end of the day, it relies on quality data. So that, investing in that will not be wasted, making sure you've got the most accurate information to allow you to make informed decisions about how much risk you retain and transfer to the market. It's got to start with quality data. So, and the second piece, in the current hard market, it's about having options. So, as Zane touched on, this might not all happen in 1 year, but over a couple of years. But it's about having options. So, starting this information or these processes early to allow you to develop the data, to develop the analysis, that you have as much time as possible to review that, to analyze it, to digest it, and then develop options with the boards, so you can go to the market from a position of strength and negotiate. Yeah.
Okay. Rob, we've got a question that's come in from Suresh around how do we assist business continuity management for clients? Is it offered as an additional fee by a separate team? Do you want to answer that?
Yeah, absolutely. Yeah, yes, it is. In short, we work with our clients firstly to understand their needs. So sometimes depending on the complexity of the business, it might be a single site, it might be a whole network business. But we work with our clients firstly to understand what we call a business impact analysis, to understand what are the critical sites or functions that sit within the business that ultimately need to be planned for. And once we've got that information, then we work with our clients to scope out exactly what work is required to develop a fit for purpose business continuity plan. But it is a standalone service that we can provide, and as I say, it's very tailored to our clients' needs.
Another question that's come in is, if a company's already doing all of these 6 actions already, but is still seeing significant premium increases, what more can be done?
That's a question to me?
Yep.
It's a good question. I suppose it's multifaceted to understand where that value isn't being achieved. It is, as you said, it is a hard market. So it's probably trying to better understand where we're working with our colleagues to understand where there is a potential gap, that one of these areas isn't adding isn't adding significant value, and working to work out where those improvements can be met. It is a difficult market. That's all I can say.
We had an example recently where we had a client who's had some significant premium increases recently, but has come off a base of very low premium increases, but weren't aware of how low it was, and through the loss modeling and the risk finance optimization, found out that even though the premiums have increased recently, they're still priced efficiently. And so that sometimes we can get caught up in the last 2 or 3 years, but sometimes it depends on what base the premium increases have come off as well. And so having that data can help you manage up a bit better about, okay, yes, we have premium increases, but it's still priced efficiently given the underlying risk profile. I think it's also good to see what's driving the pricing, having good relationships with insurers, and making sure that there's what we haven't talked about today, that what we do at Marsh is making sure that there's a quality submission, and that there's great engagement with the market, and that there's what the placement team do very well is working with local and international markets, so that this is getting broked well into the market. And so that's the other area that you would.
I think, just picking up on that point, I think this isn't a one-off, you do it now, fire and forget. This is about developing all of these and doing these on a continuous basis. And those clients that have continue to do this over the long term, when you compare them to, say, an open market where many clients may have not done these, over the long term, the benefits will see through reduced pricing and that continuity of coverage. And we see that in many examples where our clients, because of this proactive risk management program, have outperformed the market over the long term.
Yeah. If a client was starting and looking at these and hasn't really got a lot of sophistication at any of these, where should they start? Rob, any direction on that?
Well, I think you start with the data. Let's, we say we've got a huge amount of experience of understanding where the data can be improved that will get the most benefit, and we see that in a really tangible example is Nat Cat modeling. We understand the models and we understand what has the most influence over the generated loss estimates that come out of those. So let's start with the data and work out, okay, where if there are improvements that can be manifestly generated out of improving the data, let's start there. If it's not data, then let's look at the limits and understand, do the limits, are they fit for purpose? In a soft market, many clients have topped up those limits. Is there the opportunity to reduce those? And let's bring some science to that and work through those. They said, for some of the more sophisticated clients who are, who've had bad balance sheets that can take more risk, then the discussion starts to evolve in looking at, the ability to take on more risk. But ultimately, it has to start at improving data.
Okay. And when is it too late to make an impact on a renewal, Rob, in terms of timeframes leading up to renewal?
Well, as I highlighted, I think it's about starting as early as possible. Probably the last thing you want to do after a very difficult and challenging renewal is to start talking about the next renewal. But I think it's about doing that recap and understanding where the potential gaps in the data, gaps in the analysis, and starting as early as possible. If we're going to start, if in a hard market, start to look at those more challenging options around retaining more risk, then those are discussions that really need to happen as early as possible and have the most informed analysis to support those discussions. And ultimately, those discussions will probably be required to be had with the board and senior management, and therefore they will take time to go through. So ultimately, we recommend these processes start as early as possible in the renewal cycle. But can improvements be made right up until renewal? Absolutely. We're working with clients now where insurers are challenging some of the sum limits and some of the logic behind why our clients require those sum limits. And we're working with our clients right up until the last minute to provide that analysis to support that negotiating position as to why that cover is required. And as I touched on earlier, it's about having that informed analysis to potentially trade cover. So if you own that analysis and you own that knowledge and insights, it puts you in a very strong negotiating position. So if insurers are looking to put pressure and reduce it, then potentially you have that insight as to where you will concede cover, but where you will argue to retain cover. So there is no sort of line in the sand as when you can't add value, but it does get more challenging the closer to the renewal. So argue go as early as possible, have the most insightful analytics and data at your hand, but you can still make it insights right up until the last minute.
Great, thanks, Rob. Now, there has been a couple of just insurance broking related questions about client renewal meetings and extensions, period extensions for renewals, and we'll take those on notice that often they're questions that are related specifically to your insurance program and the relationships you have with underwriters. Is it valuable to have discussions outside the renewal cycle? Often that comes down to the relationships that are existing and the size of the risk and the type of risk. And with the extension of the policy, having what Suresh's question around having an extension for 1 month. We've got the placement team that can talk about some of those specific sort of insurer relationship insurance questions there. But look, I think what we are going to be going from now is we finished the Q&A. If you have any other questions really quick, please don't hold back. You can send them into the Q&A function. There will be a survey as when you finish up today. But let's talk. Talk to your broker, feel free to reach out to Robert or I. How we try to add value is working with your broker, getting involved in the insurance renewal, identifying where there's an opportunity to help, and often just providing education and awareness. You know, we're talking about the topic, and that is a service that we offer. It's part of being a Marsh client. It's about what we do. It's complementary. It's part of our service. We go in, we educate, we talk about it, we identify those areas where we think there's opportunity. And so please feel free to reach out. We'll be sending a copy of the presentation to everyone as well. And when the webinar's finished, that survey will pop up. It won't go in your inbox. It'll come up in at the end of this, so it makes it easier for you to just click a few of the answers and stay. So you'll see that coming along. But thank you so much. We really appreciate you being involved today, and we're going to be continuing these renewals discussions and business resilience series. So please keep an eye out, and look forward to talking to you soon. Thanks, everyone.